Have you ever looked at one of those dense financial reports, like for an investment fund? I just wish someone could, I don't know, boil it down for you, cut through the jargon. Feels like you need a translator sometimes, right? Well, guess what? That is exactly what we're tackling today. We are doing a deep dive into mortgage investment corporations, or MICs, and specifically, we're looking at one called AP Capital MIC. Yeah, our mission here is pretty straightforward. Take this stack of documents, their fun facts, the May 2025 update, and just pull out the really important stuff, the key insights, maybe some surprising bits, and really help you get a handle on how a fund like this actually works, basically cutting through the noise to get to what matters for you. So let's just jump in to kick things off then, maybe just a quick refresher. What is a mortgage investment corporation? The basics. And then looking at AP Capital MIC, what are we talking about in terms of like size and scale?
Right. So a MIC, fundamentally, it's a pool. Investors put their money together, and that pool is used to invest in mortgages. So instead of you lending on just one property, you're diversified across many. And when we look at Aki Capital MIC specifically, the numbers give a pretty clear picture of their scale. They have $255 million in mortgages under administration right now.
Okay, 255 million.
Yeah. And looking back a bit, their history is significant. Since they started, they've funded cumulatively over $1 billion in mortgages.
Wow, a billion.
That's across 436 mortgages funded since inception. Now, you might also see a number like 2,555 mortgages mentioned in their fun facts. It's more of a total historical figure. But the key number for right now, their active portfolio as of the May update, is 467 mortgages. So you get a sense of both their long history and their current operational size.
Okay, that definitely frames it up. A billion funded historically, around 255 million under administration now, with nearly 500 active mortgages. So where are these mortgages, geographically speaking? What kind of properties are we talking about? Is it spread out or more focused?
It's very focused, actually. The documents show a really heavy concentration in British Columbia. 94% of their mortgage funds are in BC.
94%. Wow, okay.
Yeah, and the remaining 6% is in Alberta. So their fortunes are definitely tied to the Western Canadian economy, especially BC's.
Right. And the loans themselves, what kind are they?
Good question. So about 75% of the funds are in first position mortgages.
Okay, first position. So they get paid back first if something goes wrong.
Exactly. It's generally considered lower risk. The other 25% are in second position. And in terms of property type, it's overwhelmingly residential, like 98%.
98% residential. So mostly houses and condos.
Pretty much. If you break it down further, single detached homes are the biggest chunk, 62%. Then you've got serviced and urban lots at 29%, condos make up 6%, and townhouses just 1%. Oh, and another detail, 45% of these mortgages are on properties where the owner actually lives there, owner occupied.
Okay, so BC focused, mostly first position, overwhelmingly residential, mainly single detached homes. That paints a pretty clear picture of their niche. How does knowing all that help us understand their strategy and maybe the risks involved?
Well, it tells you a lot. That BC concentration, for instance, it suggests deep local market knowledge, which is good, but it also means less geographic diversification. If the BC market struggles, they feel it more directly. The high percentage of first position loans, that points towards a more, let's say, conservative lending stance compared to a fund heavy on second mortgages or maybe riskier commercial stuff.
Right.
And knowing the property types, mostly standard residential, tells you they're focused on, foundational real estate, not necessarily speculative projects.
Right.
It sort of defines their risk appetite, a preference for established residential markets.
That makes sense. It gives you a real feel for their operational DNA. Okay, so let's shift gears slightly. What about the borrowers? And how does the fund manage risk? What do the numbers tell us about the health of the loans?
Sure. So the average credit score for their borrowers is 716.
716. That sounds pretty decent.
Yeah, generally considered a good score. In terms of issues, currently 4.69% of their portfolio is in foreclosure.
Okay, under 5%. And for those specific loans in foreclosure?
For those ones, the average loan to value, or LTV, is 46%, which is quite low, meaning there's significant equity cushion even in those troubled loans.
Right. Lower LTV is generally better from a lender's perspective.
Exactly. And it ties into their current lending, too. Like, the new mortgages they funded in May had an average LTV of 61%. And they specifically point out that this is well below the fund's 70% target.
So they're actively lending below their own maximum threshold. reinforcing that conservative approach.
Precisely. And they seem comfortable with that foreclosure rate staying below 5%, stating that the remaining portfolio of borrowers are meeting their mortgage payment obligations, underscoring the stability and quality of our investments. It suggests they're actively managing things and feel the core portfolio is strong.
Okay, so 716 average credit score. Foreclosures under 5% with low LTVs on those. How does that stack up generally? Does it signal, resilience?
It's tricky to give exact comparisons without specific benchmarks for this exact type of MIC, but yes, a 716 average score indicates they're generally lending to financially sound borrowers. And keeping foreclosures below 5%, especially given recent interest rate moves, suggests pretty robust risk management.
Okay.
It implies they've got solid underwriting. They probably act quickly on problem loans. It points towards a focus on protecting the capital in the fund, mitigating that downside risk.
Got it. Okay, let's flip the coin now and look at it from the investor side. If you put money into AP Capital MIC,
Yeah.
what's that experience like? How many investors are there? What are the returns, the options?
Right, the shareholder experience. So they currently have 1,685 shareholder accounts. And they've seen some pretty solid growth recently.
Oh, yeah.
Yeah, since the start of this year, January 1st, 2025, they've brought in 269 new share purchases. That represents about $13.5 million in fresh equity.
Wow.
Which pushed their total equity over $215 million, and their investor base is now, as they put it, nearly 1,700 investors. So definite momentum there.
That does sound like strong investor confidence.
Yeah.
And the returns. What are the yields?
So they have different share classes. Class B shares are yielding 7.5% per year, and Class F shares are at 8% per year.
Okay, 7.5 and 8%.
And a really key point they highlight is the consistency. They've paid distributions for 183 consecutive months.
183 months straight. That's over 15 years.
Exactly. The latest was just paid June 2nd. And investors have options for how they receive these payouts. About 53% take it as monthly cash, while the other 47% choose to automatically reinvest those distributions back into more shares. That's the DRIP, the Dividend Reinvestment Plan.
Right, the DRIP option.
And in terms of how people invest, about two-thirds, 67%, are just regular open or cash accounts. The other third, 33%, are using registered accounts, RRSPs, TFSAs, things like that. Oh, and a really crucial detail. All the returns, those 7.5% and 8% figures, they are quoted after management fees have been deducted.
That's important. Net of fees.
Very important. And the whole distribution process is managed by a transfer agent called SGGG Fund Services, and investors get online access to their accounts.
Okay, that's a really comprehensive look from the number of investors and recent growth to specific yields, the amazing consistency, the DRIP option, and how it's all managed gives you a very clear picture. So let's maybe tie this together with a look at their very recent activity. What were they actually doing in, say, May and the first half of this year? Does it line up with this picture of consistency?
It seems to. In May 2025, their team advanced 37 new mortgages, putting out $17 million.
Okay.
And during that same month, they got $13 million back from 20 mortgages that paid out. So money going out, money coming in.
Steady flow.
Yeah. And if you look at the first half of 2025 overall, they funded 196 mortgages. They note this closely matches our total for the same period in 2024. So that suggests, a stable, consistent pace of business.
Interesting. And how does that recent activity connect to their longer-term performance? You mentioned that 15-year distribution track record.
Right. The documents actually include a chart showing the compounding growth. It illustrates how a $100,000 investment made back in 2009 would have grown to $336,190 by the end of 2023.
Wow, over tripled.
Yeah, based on their simple interest audited yield net of fees. It really shows the potential power of that consistent yield compounding over a long period in this kind of investment.
That's a powerful illustration.
It is. But of course, you absolutely have to mention the standard disclaimers they provide. They're very clear. Does not reflect tax consequences. And crucially, past performance does not guarantee future performance.
Always the important caveat.
Always. They state it plainly. Historic returns set out above are net of all fund expenses and management fees. Past results are not indicative of future performance. You have to keep that front of mind.
Absolutely. But seeing that recent activity, the consistent funding pace, alongside that impressive long-term compounding chart, even with the caveats, it does give you a sense of their operational strength and track record. What do you think really drives that kind of consistency over such a long haul?
Well, based on everything in these documents, it seems to boil down to a few things. That clear focus, Residential mortgages, primarily BC, mostly first position. It's a defined strategy.
Right.
Combine that with those conservative lending practices we talked about, the LTV targets, the focus on credit scores, and then the fact they generate enough income from the mortgage portfolio to pay out those distributions month after month. That stability seems key. It really looks like disciplined execution of a specific plan year after year.
Discipline and focus. Okay, so we've really dug deep into AP Capital MIC using their own documents. We've seen their specific operational focus, their conservative approach to risk,